Hello everyone, welcome back to my channel. So today I want to make a video about stock valuation as it was requested. So I look at some of the valuation method. I basically want to introduce three, that including PB, PE, and PEG. So now let's get started. So first, a lot of investors like to use PB as a valuation method to measure whether the stock currently is trading on the higher end or the lower end. And the PB was calculated by using market capitalization divided by total equity. Total equity we can calculate by using total assets minus total debt. So that is very basic way, that usually a accounting way to calculate the value of the company. To see that how much the company is worth right now, and yearly the lower PB, the lower risk, because that shows the current market cap is very similar to the current equity value. And the PB method is very good for traditional companies, especially the banking companies. Like Warren Buffett said that when he evaluating the banking company, he usually look at the stocks that PB is lower than 1. So when PB is lower than 1, that means the current market value is actually smaller than the current equity value. So that shows the stock is undervalued. And I also remember that Warren Buffett also used PB to value his own company. He has mentioned that he thinks when the PB is lower than 1.2, it's maybe a good time to buy Berkshire Hathaway stock. So the second measure method is PE ratio. PE ratio is market cap divided by the net income of common stockholders. So PE ratio is like price to earning ratio. It shows that how many times the stock price it is comparing with the current earning. And it's probably the most commonly used method that even when Ray Dalio talk about some stocks, he also uses this indicator. So in average, the PE ratio for S&P 500 is around 13 to 15. And currently, a lot of like giant tech company is over that. For example, current Apple's PE ratio is 34. That means people want to pay 34 times of the earnings to buy the stock because they believe there will be better return of the stock in the future. In terms of PB ratio or PE ratio, there's both some disadvantage of it. Like PB ratio only calculate the equity amount from accounting perspective, and some intangible account may be difficult to evaluate in this point of view. And for the PE ratio, it's just measure the past data, but it may not necessarily like forecast the future. For example, Amazon's PE ratio has always been very high. I remember last time I saw it, it was over 100, and currently the PE ratio is 96. So that just shows the situation in the past. But when the new earnings come out, if the earnings is less than expected, the PE ratio will going up. If the earnings is more than expected, the PE ratio will going down. So that means even though Amazon's PE ratio is already very high, that doesn't show that the stock price cannot going up further. The third measuring method is to use PEG, which is calculated by PE divided by the annual EPS growth. So unlike PB or PE, it just a calculated assets valuation, and that cannot show the growth in the future. So for a lot of growth stocks, investors like to PEG in order to put the growth rate also in the measuring. So when we look at PEG, usually when the PEG is larger than 1, that means the stock is overvalued. When PEG data is lower than 1, that means the stock currently is undervalued. And PEG is also the ratio that Peter Lynch likes to use, as he thinks the growth potential is the most important part that investors should focus on rather than a lot of like past financial data. So other than these three measuring methods, there's also PS and ROE and EV divided by EBITDA. When we're using this method, we may want to comparing the PE ratio like situation from past to the current situation, and also we want to compare with their competitors. For example, several months ago I was debating whether I should buy Apple stock or Google stock, And that time I look at their PE ratio and I found that comparing with other tech giant, Google has the lowest PE ratio. So that's why I chose investing in Google at that time. Because the different nature of different industry, their ratios may be very different. So I think it makes more sense if we compare the stocks in the same industry. So that's all about some stock evaluation methods. Thank you guys for watching, and I will see you guys in my next one. Bye.